Hello and welcome to yet another episode of ICICI Prudential Mutual Fund and CNBC TV18 presents Smart Investors. In today's episode, we'll be focusing on multi-asset mutual funds and how they are an important tool in the portfolio to withstand market volatility. And to discuss more about this, I'm joined by Ihab Dalwai, who's the fund manager at ICICI Prudential Mutual Fund. Ihab, welcome to the show.
Good morning. Well, thanks.
Hi. So before we get started, just to give a bit of perspective to our viewers who are tuned into the show. So, volatility is something that you can't avoid when you're investing in financial markets. That's pretty much an integral part. And the adage that, don't put all your eggs in one basket is quite popular. And multi-asset mutual funds help you kind of diversify your portfolio in such a way that even when markets are volatile, you're able to both withstand the volatility as well as able to generate decent returns. So what exactly is multi-class mutual funds and how does one go about investing in them? So Ehab will be telling us more about that on this show. Ihab, so over to you. So we've been hearing a lot about multi-class mutual funds, why they are very important, especially in today's context when you're seeing wild swings across asset classes. Now the whole idea of investing in a diversified fund basically is that you get exposure to various kinds of asset classes, both each of them moving differently based on the macroeconomic situation of in a particular country. So you have tell us what exactly is multi-class mutual fund and how do they function?
Yeah, sure. Thanks. See, broadly, absolutely, what I feel is that one should have an asset allocation framework while investing, and within which I feel the multi-asset category is a fantastic product. So out here, what it tries to do is that it tries to invest in three different asset classes. So currently, it is equity, debt, and a bit of commodities, and within which it is predominantly gold. And the reason why I say it is a very good segment to be in is predominantly because of two aspects. One is the risk of the product is low through diversification because most of these asset classes have historically shown different returns in different phases of an economic cycle. So through diversification, you reduce the risk. And the outcome of this is that the risk adjusted return for the investor is superior. So that is one key important aspect of a multi-asset fund. The second important aspect is that it's a very cost-efficient way of allocating capital across different asset classes. So, for example, if an individual wants to shift from one asset class to another, for example, the tax incidences would be higher if he wants to do it at an individual level. But if he does it through an mutual fund, especially through the multi-asset fund, the tax incidences will be lower for him. So the two key important aspects is that the product tries to reduce risk and as a result of which increase the risk adjusted return for the investor, and it is more cost efficient method of allocating capital across asset classes if one is actively looking to shift from one asset class to the other.
So I just wanted to understand, does this mean that almost all the multi-asset mutual funds are predominantly have a equity as the predominant chunk? How does
So
that work?
yeah, I got it. So basically, see, like if you compare the three different asset classes, the historical returns of them, equity on the long-term basis ends up giving one of the highest returns on different asset classes. So if you look at the current 3-year, 5-year, 10-year return of the indices, it is close to around 15%, and which is superior to the other two asset classes. So generally, there's a bias towards having a higher allocation to equity within these in these funds. And second, to maintain the equity status of the fund, generally the most of these funds have a gross exposure of about 65% on the equity side. So generally, these would be more equity focused funds.
And are there any examples of ones which are not equity focused in the sense that in that case, what would the typical mix be like?
So most of them are equity oriented, but there are a couple of funds which are less than 65% gross as well. But then the taxation for those funds shifts to debt taxation, and
Okay.
the tax incidence for the ultimate shareholder would be higher in that case. But
So,
majority of them maintain the equity status.
okay, so the tax incidence is something that prospective buyers need to keep in mind when they choose a multi-asset
Correct.
mutual fund.
Correct.
We are seeing a pretty interesting phase right now in the market. Previously, there used to be a wide divergence between the way various asset classes would perform, and right now you're almost seeing a phase where almost everything is going up at the same time. So how does this, from a fund manager's perspective, how challenging is this?
True. What I've seen historically is that most of the investors are very active or excited or eager to invest in an equity rally. But at times, what people tend to forget or avoid is that there are phases in market when one has to protect capital, or capital preservation becomes a very important aspect of investing as well. So, just to give an example, if the equity fund manager is of the view that market currently is at a higher valuation, we are at an up cycle currently, and there aren't too many absolute return opportunities available in equity. So, generally, what the category or the fund would try to do is that it would try to reduce the equity allocation and would want to allocate more to debt or gold. But historically, what we have seen is that these assets perform differently. Like, for example, we can say that gold is an hedge for inflation. If you want to protect capital and you think there is volatility, you would want to reduce your equity allocation and would want to move to a steady state asset class like debt. So it is up to the equity fund managers who determine how these asset allocations between these funds would move.
So how, for instance, yeah, it's the fund manager who takes the call on how the
Correct.
asset allocation. Is there any fixed intervals at which they decide, or is it very dynamic?
So broadly, what I feel is that there are two ways of arriving at the asset allocation, the weightages which one can assign to each asset. So one is you can have a very model-driven fund where you try to build a model, you backtest it, and based on the success of that model, you determine the weightages for each asset classes. But there is a second approach to it, which is a model assist approach, which I feel is that each of the asset class fund manager would try to build models to determine how each of this asset class has performed in different phases of the market, and based on that, try to take an educated approach towards having a weightages to each of these asset classes. I personally feel that when there are two asset classes involved, you can have a very systematic model driven approach. But when there are three or more asset classes which are involved, I think it is prudent to have a model assist approach where most of the fund managers would have models for most of these asset classes and try to assess how this asset class, or try to bring up or build up an expected return for these asset classes and build and allocate weightages to each of them.
Ihab, I would also like to understand your outlook currently on each of these asset classes at this point. How are you looking at equity? True, I mean, equity does give superior returns over the long term very clearly. Right now is also a time where there is a lot of turmoil happening on the debt side also, and on the commodity side as well. So I just wanted to know your outlook on each of the segments at the moment.
Yeah, sure, sure. So equity right now, see, broadly, what I feel is that the if you look at valuations, valuations is likely trading at a higher multiple than what they have traded at a historical level. But the earnings growth expectation is expected to be pretty strong. There might be a quarter or two where the higher input costs currently can have some pressure on earnings, and one can see a bit of certain downgrades in earning estimates. But I believe that over the long term, we are poised for a very good earnings growth recovery. This again is reflected in where are we in the business cycle. Clearly, we are in the early stage to mid stage of a business cycle where the earnings growth expectations has to be strong. So if one approaches, slices and dices sectors or segments which one wants to invest in, one can build up in a decent equity return portfolio in the current juncture as well. And to bring out to a point in terms of the equity portion of the multi-asset fund, it is a purely flexible approach. The fund is not constrained by any sector. The fund is not constrained by capitalization. So there's a decent enough flexibility in terms of how we would want to build up the portfolio. But mind you that the style of the equity would ultimately be reflected in the style of the fund manager who's managing the fund. So if in case the fund manager is a growth oriented fund manager, if he's quality conscious or value conscious, that would ultimately be reflected in the equity portion of the allocation. But the equity side is pretty flexible. Coming to the debt side, our internal view is that it has to rates are expected to go up. So we are on the floating bond is something which we are currently positive on. And gold, see, gold, what we have seen historically is that there is a very good correlation between US real rates and gold performance. So if the view is that US real rates are expected to go down, gold ends up delivering good returns. So in terms of taking a view on the gold, are actually a debt team plus the commodity team. Generally, it's the debt and the commodity team which sits together and takes an informed view on the on gold as a commodity.
Okay, so this is a question, just so that our viewers also get a better understanding. When interest rates are rising, does it make sense to invest in debt funds, or how does it work in general? Is it time to then increase exposure to debt? Is that how it works? Because
So yeah.
yeah,
So
sorry, please
floating
go
is
on.
yeah, sorry, I'm saying floating is a good category. It protects you from the rise in interest rates. So floating bond is a good category to invest in if the expectation is that rates are going to go up. Uh, but uh, but having said that, it's not necessary. I agree to your point that one can have an higher allocation to equity because equity is also considered as an inflation hedge. Gold is also considered as an inflation hedge. At the given juncture, I would say that allocations would be more biased towards equity and partly towards gold versus what would be towards debt.
Okay. And just one more thing, I'm continuing with your outlook on equity. How do you see crude prices? What kind of an impact do you see it having on the overall macro situation, and then it feeding into the micro level as well?
So at a macro level, India being an importer of crude, I think it impacts at a macro level. But if you look at the micro level, obviously there are beneficiaries which benefit out of higher crude prices as well, and there are other consumer companies as well which can see some earning hit because of higher crude prices. But broadly, I feel the on the consumer side, the brands are pretty strong, and the companies are also pretty strong, and it is only a matter of time, over a period of time, that they would pass on these issues of input cost pressures to the ultimate consumer, and can be an interim hit on profitability, but ultimately I think it would be passed on to the consumer.
Coming back to multi-asset mutual funds, as a proportion of the overall assets in the mutual fund industry, how big is this segment,
Uh,
roughly?
so it's not developed as much as one would have expected, and as much as the potential of the sector is, because I believe that the function of risk adjusted return is a very important function which an investor has to consider, and it's not much reach to the investors knowledge that that is a very good parameter to look at the time of investing, because protecting your drawdown or protecting capital in a falling market or in a volatile market is very important. Because mind you, what falls 50% has to rise 100% to reach at the same level. So protecting capital is very important, and I feel that the structure of this fund is such that this concept of protecting capital is inbuilt into it. So it is a very strong feature in this fund and category, and I feel that the potential for this category is humongous.
You just mentioned risk-adjusted returns. This is a concept still many investors are not very familiar with. I mean, they keep hearing about it, risk-adjusted, but I don't think the fully most investors, especially the newcomers, understand what this is about. Could you just take our viewers through that? When you what exactly you have in mind when you say risk-adjusted investors, which
So
investors should be keeping an eye out
correct,
for?
correct. So broadly, see, risk can be defined in two words. Like the financial literature says that risk is either the volatility in your returns, which you see, or at times there is a conventional school of thought which says that drawdown or capital protection is important for them, and they see absolute loss also as a risk. So what these funds endeavor to do is that it tries to reduce the volatility in the return of this fund, or tries or makes an attempt to protect capital in terms of drawdown. So it tries to reduce the denominator. So any risk adjusted return formula would be your return divided by your risk. So it tries to reduce the risk which would be attributable to the fund, and as a result of which you end up getting a decent return for the risk which one has taken.
Okay. Ihab, when people start out on their financial planning journey, they're typically told that based on your risk appetite you should have X amount of equity funds, X amount of debt. But multi-asset is still not something which is, as you also said, is yet to gain in popularity. So while for a new investor to mutual funds, when he's creating a portfolio of different funds, uh, you know should he have a multi-asset uh, fund early on in his cycle as an investor, or this is more suited for someone, let's say, who's at a slightly uh, later stage of his working life?
Correct. I feel this fund is suitable for the entire spectrum, right from the start, which is an early investor or first time investor, because it allows him access to equity returns and at a lower risk. So his investment journey is pleasurable or enjoyable for him, because he's a first time investor. Equally, I feel that it is suitable for a person who is in a later stage of his investing career. It is suitable for a person who's retired, a pensioner as well, because for them capital protection becomes a key focus. And like I said earlier, this feature is, or the attempt to protect capital has been a key feature or an of inbuilt into the structure of these funds. So I feel it's suitable at both the extremes, and obviously the people in between the investing career journey as well. But it's suitable for almost all type of investors.
So ideally, let's say, what proportion of your mutual fund portfolio should be in this? Let's say you're a high risk taker, you're willing to take high risk taker. Let's take consider two cases. Let's say one who's willing to take high risk, who's typically at the early stage of his career, working life, and let's say someone who's midway through it. So what proportion then would
See,
uh,
frankly, I would keep a chunk of my investments in this if I'm not an investing professional, because daily or the routine or regularly determining what allocation has to go in which asset class is ultimately left to the fund management team of the mutual fund managing the fund. So I don't have to go through the hassle of the entire process. And like I mentioned earlier, the cost efficiency is also better in this setup. And so I would have a significant allocation if I'm not an investment professional into these categories.
share some of your experiences as a fund manager while managing a multi-asset mutual fund.
So like I mentioned earlier that I prefer the model assist method versus a model driven method when it comes to more than two asset classes to manage. So it is a very interesting experience in terms of sitting together with the debt team, commodity team, and bringing the equity expertise into the discussions and trying to identify how should we allocate capital amongst the three asset classes, and which I think will because what we as a mutual fund community bring into the picture is expertise from each of these asset classes. So we have a bouquet of equity funds which as a mutual fund one manages. and also we have a bouquet of debt funds which one manages. So broadly, I would say that the best of the equity is reflected in the equity portion, and the best or the highest conviction debt ideas are reflected on the debt side of the multi-asset fund. So it brings the best of both the worlds, is what I would say.
Ihab, are there any misconceptions about this fund? Obviously, when distributors go and try to sell this product to investors, are there any misconceptions about it which you would like to clear?
So broadly, I think one would be that I think allocation to different asset classes is something which we would want investors to be more aware about, that it is predominantly an equity product because it's an equity oriented product. It's an equity plus plus product where we try to bring in the equity upside as well. But at the time of caution, we would want to reduce the equity allocation and try to protect capital and increase allocation to other asset classes like debt and gold to preserve capital. I think once this message is gone through to investors, I feel this product would be very well accepted.
And Ihab, how does one invest in multi-asset mutual fund? Do they do it through a lump sum route? Should you try to, strategically and opportunistically also invest, or should you just follow the SIP route, which is just, just keep putting money, forget about it? What do you recommend?
So I feel that if anyone who has any surplus savings at any point of time should lump sum invest into this fund, because one need not worry about whether they're timing the market well, because that decision ultimately is taken by the fund management team. Apart from this, if that is not the case, I strongly feel that SIPs also can be started in this fund. And as a concept of SIP, I'm very fond of it because it inculcates an habit of first saving and investing and then spending what remains, unlike the earlier convention of first consuming and then you save and invest what remains. So it brings in saving and investment to the forefront of a financial planning decision.
This question, this question is not directly on multi-asset mutual funds, but
Yeah.
we are seeing a sudden change, overall in terms of perception of investors towards mutual funds in general than what it was, let's say, till about 2 or 3 years back. As a industry professional, could you, shed some light on this? Are you seeing any very noticeable trend, shift in trends as far as investment into mutual funds as an asset class go? Of course, we have seen the numbers, that the SIP chunk seems to be getting bigger with every passing
Correct.
month.
Correct.
Equity inflows also have been quite robust now for quite some time now. You've had a non-stop winning streak as far as inflows go. So, what are some of the key behavioral changes that you and your team may have come across during this period?
Correct. So, like you correctly mentioned, that SIP is something which is very steady, and over month on month, we see the numbers which come in. And apart from that, personally, what I've seen is that investors have ultimately accepted the fact that the hybrid as a category is a very good category to invest in over a long-term period of time. Like I'm being mentioning about the risk-adjusted return concept, at least in balance advantage fund as a category, I think investor has clearly accepted that, which I feel is also possible in multi-asset fund as a category as well. But hybrid as a category of a means of saving long-term money for lower risk and also having a participation in equity, I think this culture has picked up in a big way, and I think there's a lot of headroom for this category to grow as well.
Just one more thing, Ihab. Now, okay, in the past, we've seen sudden rush of money coming into mutual funds. We saw that around 2016 to 2018 there was a big surge of money coming in. In the previous bull runs also you saw a lot of money coming in. When equity markets rally, that's when it typically grabs the attention of investors. Do you see that changing, or have we overcome that that particular aspect of, I would say, a behavioral bias, that people just coming in when uh, markets are rallying. And do you see something like that? Let's say markets were to underperform, probably you could see some bit of uh, sharp slowdown in the flows that come into mutual funds in general.
Correct. See, I feel that the mutual fund investor is slightly a matured investor than what the surge which we have seen in retail participation or the direct retail participation, what we have seen. So I think, irrespective of market conditions, depending upon the category or the funds which they want to invest in, but I think these acceptance of mutual fund as a category has been very well absorbed by the investing community. If there is some volatility, I think, which can impact the pickup what we have seen in the direct investing segment, but I feel that the mutual fund investing would continue, is what I broadly feel.
We are also seeing a sharp increase in the number of demat accounts, and some people say that a lot of investors want to enter the market directly. Also, do you see that as some kind of a serious competition for mutual funds? More people wanting to try their luck directly, or can this trend sustain?
Correct. And I feel that the people who've come up in the direct approach, I think they're the more the younger generation who just wants to have an experience of how to invest directly into equities. What we see is that the participation in the derivative markets is higher than what they participate in the long only buy and hold strategy of direct equity or cash buying in equity. I think the investing categories itself is different, and we will have to see how that category would behave in case market tends to remain where it is, or in case there is some minor correction in markets. It is something which I think one will have to see how they behave, because these are like younger generation who have access to direct investing, maybe through a mobile phone app, or the process of investing has become easier or simpler, and the cost associated also have come down. So we will have to see how they behave in these phases of the market.
Yes, so the numbers so far have been very, very robust. I mean, every month the SIP numbers simply, they seem to be an uptrend, which is a. I recall this conversation I had with a fund manager. This was way, way back. He was mentioning, equity fund manager was saying that we typically face the same problem, that when markets are rallying, too many people, there's too much money coming in, and as soon as the market corrects, there's just sudden rush, which means that we have to sell the better quality shares.
Correct.
So it would be much better if a set amount would come month after month, which is what has now been the case. uh, that said, too much money also coming in, does that make matters tough for a fund manager? Given that, if you look at the universe of investable, companies, well, there are, well, thousand odd companies listed. I mean, fund managers also say that one challenge is to identify the really good companies. So too much money coming in, is there a problem of plenty at the moment?
So, frankly, one has to identify sectors or segments or categories in which they want money at a particular point of time, determining or making a estimate of how that sector would perform in the near future. So, having said that, I feel money which comes into categories like balance advantage fund or multi-asset fund, how most of these funds are designed are that they are a bit counter-cyclical in their approach. So when markets tend to go up, the equity allocation tends to go down, and as and when markets correct, the equity allocation increases in these funds. So having a counter-cyclical approach to investing, especially in terms of equity levels, also within the hybrid category, I think resolves the problem of how the investor behaves in terms of how market moves. So if investors going out at the time of when markets are not doing well, I think having a counter-cyclical approach in terms of managing a net equity helps a lot to address that challenge.
So there will be a lot of first-time investors who are also tuned into this show. So what would your advice to them be? I mean, not necessarily specific to multi-asset mutual funds, but
Correct.
also, a broader kind of advice on how they should go about the whole journey.
So I would say that one should, like, the sooner you start investing, the better it is. because obviously value compounds over a period of time. And you have to, like, if you are a new investor, it's always good to come through a mutual fund setup, and it is better to come through an hybrid category, because given where the market valuations are today, I would prefer for a new investor to come into the hybrid category currently, be it multi-asset fund or balance advantage fund currently. But one should not shy away from investing, because given one because of the, because only giving valuation as a reason, because long-term earnings growth potential in India is significant. Valuation can take away or a one-year return, or can stop a one-year return, but over a long-term period, what we have seen is that equity tends to give a nominal GDP growth rate at least. So one should have equity as an allocation in their investing and savings as well.
We have one question on interest rates now. The FOMC will meet next week. How do you see the interest rate changes in the US having bearing on rest of the markets, across the globe, including India?
So broadly, what we see is that one, as an emerging country, or other countries can't have a very high differential to interest rates, which what US interest rates are. So if globally central bankers are moving towards tightening, I think ultimately, because of inflation, the other countries also would have to pick up, would have to look to raise rates, or would look to tighten the liquidity in the environment. So I think it's pretty significant. And in that context, generally what we see is that there are two impacts. One is that the cost of equity generally tends to go up when you end up valuing equities as an asset class. And at times it does impact a corporate who is a bit levered as well, because his cost of borrowing also goes up. So these are certain factors which one has to keep in mind while investing.
Well, thank you so much, Ihab, for joining us and um, helping our viewers have a better idea about what multi-asset mutual funds are all about, and why this is a good investment bet for investors right across the spectrum, whether they are at the beginning of their working careers, or midway, or even towards the end. Thanks for clarifying on a lot of aspects, and thank you all for watching this episode of Smart Investor.
Thank you, Santosh.
Thank you.
दूसरा रन लेने की कोशिश, लेकिन ये रन आउट।
चाचू रन आउट।
कोई जरूरत नहीं थी रन लेने की।
इन्हें तो साथ भेजना ही नहीं चाहिए था।
कौन मैदान पर आता है?
अब अगला कोई एग्रेसिव प्लेयर आए तो सही होगा ना।
अरे अग्रेसिव तो खड़ा है ना स्ट्राइक पे भैया। कोई डिफेंसिव प्लेयर है तब तो जोड़ी बने।
लेफ्ट हैंडेड बैट्समैन की जरूरत है। लेफ्ट हैंड और राइट हैंड का कॉम्बिनेशन बॉलर्स को भारी पड़ेगा।
और ये कैप्टन का सही डिसीजन, लेफ्ट हैंडेड बैट्समैन की एंट्री।
सही जोड़ी ही मैच जिता सकती है। इसलिए जब हो आपका टैक्स प्लानिंग का मैच, आपको चाहिए टैक्स सेविंग्स और वेल्थ क्रिएशन की सही जोड़ी, जो आपको मिलेगी ELSS फंड के साथ। जब जोड़ी राइट तो फ्यूचर ब्राइट। ICICI Prudential म्यूचुअल फंड, तरक्की करें। Mutual fund investments are subject to market risks. Read all scheme related documents carefully.